Docusign stock has taken a tumble, and in the next 90 seconds, we're diving deep to uncover exactly why. First, let's consider the big picture market trends. Zooming out, we see rising interest rates and inflation fears impacting growth stocks across the board. Think of it like a rising tide sinking all ships, even Docusign. These macroeconomic factors create an environment where investors are less willing to bet on future growth and more focused on immediate profitability. Docusign, once a darling of the pandemic-era digital transformation, is now facing tougher scrutiny. Now, let's zero in on Docusign's own performance. While still growing, their growth rate has undeniably slowed. This is partly due to increased competition in the e-signature space and partly due to the pandemic-fueled surge in demand normalizing. Competitors are nipping at their heels, offering similar services often at more competitive prices. This price pressure can squeeze margins and impact investor confidence. Furthermore, any downward revision in Docusign's future revenue projections, also known as guidance, can trigger a sell-off. Investors react negatively to lowered expectations. Finally, keep an eye on analyst ratings. Downgrades from prominent firms can signal a lack of confidence in the company's future prospects, further fueling the stock's decline. It's not always a guarantee, but it is an important factor. So, in short, a combination of challenging market conditions, increased competition, slowing growth, and revised expectations are likely contributing to Docusign's stock price decline. Keep an eye on these factors to understand the future direction of the stock.